in the press just in the last day or so that Australia's largest trading partner is now China and was Japan. I think it just shows how our sort of near regions becoming increasingly important, and trade within Asia is in itself accelerating, so much so that it's a lot less dependent on the US for its growth as an export market. Again, another trend emphasising just what is happening north of us today. Now, as we all know, the Asian story is one of explosion of growth and a bigger and increasing driver in world growth and regional economic growth. Looking forward today, that growth is pretty entrenched. It may ebb and flow, but we think it's pretty well there for the course from now on. When we think about Asia in private equity context, we're really focusing on the three big economies in Asia: India, China and Japan. Each of them is quite different. India and China, a number of similarities. Japan, very different as the sort of developed economy in Asia, with a much more developed private equity market, albeit still rather immature. Other markets of interest in the region, Taiwan and Korea, worth watching, but probably the next sort of 5 years or so will be of interest. Southeast Asia itself, a very mixed bag. The exception is probably Vietnam, which is showing some interesting early signs of fund formation and activity, probably because of its links to China. So today we're really sticking with the emerging markets, that are the large markets and the key participants, what we see will be in the Asian private equity story. We've got some interesting contrasts. India, the largest democracy in the world, since 1990 has been liberalising its economy and increasing economic freedom, and now we've seen the growth coming through in the economy. China has increased economic freedoms gradually for some time, but still very limited political freedom. So some interesting interplays over the years ahead, we think. One of the things that we have seen in these markets, which is encouraged sort of interest in private equity type funding, is that local banking, as you'd expect, is fairly limited, particularly in funding sort of growth businesses, cash flow style lending. So we see that as being sort of an important part of sort of some of the influences that are allowing private equity to build its opportunity in these economies. So we think of some of the drivers that are actually sort of pushing the growth that we're seeing and the opportunities for company formation and company growth. And a key one when you visit India or China is construction, and you see things being built everywhere. Growing populations, growing urbanisation, growing incomes, growing demand, growing consumption. In China, there's planning, multiple new urban centres. India expects some 150 million new of its citizens to live in urban centres in the next 12 years that are not living there today. So we're seeing urban landscapes created, infrastructure put in place, and no doubt the Olympics in China has been a key driver, a tremendous impetus in China for a lot of construction. But as we're all familiar with, some of the growth story, particularly in India and China, has been the story of outsourcing, and it's been sort of in two forms. China has seen outsourcing come to China from manufacturing, particularly out of the US, and outsourcing in India has largely been around services, and we've seen this picture here of the IT park in Bangalore wouldn't look out of place in Southern California or in Australian suburbs. But both the outsourcing story in India and China really comes down to a couple of key drivers: relatively low wages, capital efficiency in actually building businesses, high productivity, and economic liberalisation in those economies, allowing these sort of opportunities to actually be harnessed. And of course the contrast to India and China is Japan, which is a very different story, the second largest economy in the world in Asia, been a powerhouse of industry and growth, coming off a very long period of reform and restructure and very low growth, now settling at around sort of 2% growth. And the breadth of that economy and the skill and innovation within it, we think, provides some interesting opportunities for private equity to participate in those changes. So just to sort of recap on where we see Asia in the world, it's been a large contributor to growth. And the chart that you see here sees that, the top line, I think, is Asian the grey bars, Asian GDP, and you can see how that's been a strong contributor over a number of years, and we expect that's only going to get larger. Projected Asian GDP is accelerating. If you see US, China and India, and that relative changes in position from 2000 to 2045, that's a very compelling growth story. And if we look back sort of from 1990, China has grown on average at 9.8% per annum, and GDP has increased by 6 times. And for India, it's 6.1% with a 3 times increase in GDP. But the flip side of that is population. Even with all this strong GDP growth, we're still seeing pretty low GDP per capita, which sees strong consumption. All this income created is going to be income that's going to be looking to consume, and it's going to drive these economies to actually be generating their own growth from their own internal demand as much as from the outsourcing and export stories that we've seen to date. So just to touch on population, we know population in China is large. Population is still growing but flattening with the one-child policy. So some interesting dynamics in the Chinese demographics, and the scale of the country and the population really just means that it's going to have tremendous growth in its economy. We're still going to see 40% of China's population as rural, so still a fairly high rural quota. In India, population growth on a much sort of stronger trajectory. In the next 20 years, it's expected that India's population will actually exceed China's with a larger working age group. Urbanisation is lower, about 50% is expected to still be in the rural sector in 2030. So just looking at some of the opportunities. Obviously, we're seeing tremendous growth in some of the established urban centres. A key opportunity in both China and India is retail. It's a very underdeveloped sector in both economies. Pictures on the screen are sort of the Mumbai answer to Westfield, which is a very different shopping experience. And with urbanisation and growing middle class and growing consumer class, it's going to be a key driver for private equity. There's a lot of change and restructure happening in Japan as management cultures are changing, performance focus is moving into companies and management structures. And then sitting alongside that, we're seeing in India and China a returning group of expatriates who've been in the West, been particularly in the US mostly, gone to maybe university and business school, worked in US companies in various roles, sometimes for 20 plus years, and returning to India or China to either establish new businesses or to participate in associated areas like private equity. So just to sort of perhaps focus now a little bit more directly on private equity per se, this is global funds raised as the grey bars, and the blue line is Asia as a percentage of global funds raised. And we see the blue line for Asia actually sitting at about 4% in 2006. So in the context of global private equity, still a pretty modest story. And to place some perspective on that sort of Asian private equity, it's interesting to note the average deal size in China, India and Japan in 2006 was approximately $26 million. Japan was slightly higher at about $36 million, compared to Australia at $113 million. So in Australia there are 135 deals in 2006, and China, India and Japan all recorded somewhere around the sort of 260, 270 mark in actual number of deals done. So very different characteristics in the market, and it's very reminiscent in some ways of looking at the Australian private equity market in the late 90s and the early 2000s. So if we look at private equity funds raised as a percentage of GDP, if we look sort of globally in the US, we see sort of a more established, mature picture. And if we look at the orange line at the bottom, we see Asia. A very small percentage of GDP is actually participating or part of private equity. Again, very typical of sort of an emerging state of the Asian market. Another metric that's commonly used to look at private equity concentration is the funds raised as a percentage of M&A activity. Again, the more established markets like the US and Europe, the navy blue and the red lines. Orange line, which is Asia, a much more modest figure, and probably also indicative that M&A in Asia is still sort of developing as well. So if we look at Asia, Asia funds raised, the grey line, the little black boxes are the China funds raised, and the red line is China's percentage of Asia funds raised. So you can see that the picture for Asia is often around some country-focused funds, but also Pan-Asian funds focusing on much larger fundraisings and on much larger deal sizes. So let's just talk a little bit more specifically about China in terms of how we think about it as private equity. We've already mentioned it's the world's largest population, notable change from rural to urban, high growth economy, And it's really a trajectory we anticipate, and projections suggest it's going to be an ongoing growth economy for some considerable period of time. It's not really a 5-year story, it's sort of like a 50-year story. I'm sure the growth will ebb and flow, but fundamentally a growing region. In 1990, about 90% of production was in state-owned enterprises, and today private companies account for about 50% of GDP. It still is a communist state, but the government does play a large role. It does own much of the means of production still, but we're seeing those state-owned enterprises slowly being sold off, either in total or in parts thereof, and they are forming quite a source of supply for private equity transactions. Just the size of the economy and the opportunity for emerging new businesses means that from a private equity perspective it's a very sort of rich horizon to contemplate. China by nature is not open to examining its issues and some of its less palatable issues in public, and we've seen the recent toy issue with Mattel and sort of some of the quality issues, and outsourcing is not without risk, and I think for China and for the various external parties who use China as an outsource, there's going to be ebbs and flows in the ability to do that well and improving the quality and standard of that experience. But we see those as things that will be sorted out and developed, and things will move forward, and that will become an increasingly sophisticated economy supplying the rest of the world. Some of the other issues that we see in China are obviously civil unrest. I think at times we're going to see some policy shifts that have perhaps been a bit unpredicted, and we're going to see periods where capital may be a little concerned about the underlying forces in China. Certainly the impact of one-child policy and an ageing population, which at some point is going to impact on the number of working-age people, are all challenges and issues that China will have to address. But we still believe that the overwhelming drive of growth will be pretty important. And the environment is another area where China is going to have to address some sort of pretty significant issues. So if we look directly at private equity, some of the things that we see in China today, the opportunity for private equity is multi-layered and across a range of activities. Buyouts by nature have been not that easy to complete. Government approval is needed for many of those transactions, but transactions are completed. It does take some time to get buyouts underway, but they do happen. State-owned enterprises, as I mentioned earlier, are a key supply source, but also we're seeing a number of entrepreneurs that have developed businesses in China and are now looking for growth capital and looking at private equity as a key source for that. Venture capital is an area where China is starting to show some interesting signs as well. To date, venture capital has been largely about building businesses which are really replicas of models that we've seen elsewhere, and Baidu, which is sort of the Google counterpart in China, was a major example of that. But there's multitudes of other businesses growing, be it in telephony or ringtones or advertising in lift wells, just endless sort of applications of existing technology into new business opportunities in a market such as China, where there are a range of different needs and appetites. But the other thing that to watch for China, I think, over the next 5 to 10 years is some very significant technology that we think will come out of some of their sort of very sort of Ivy League type science and engineering universities, and we think that some of the early VC funds that are setting up there today will be very interesting opportunities over the next sort of 5 years. Exits in China have had some interesting characteristics to date, and there have been exits, generally offshore, often on NASDAQ or New York Stock Exchange, and some in Hong Kong. In fact, in 2006, there were some 64 exits or businesses listed on the Hong Kong Stock Exchange were actually Chinese companies. So who are the players in China, and what sort of funds are we seeing? We're really seeing them in 3 categories: global, Pan-Asian and local. So the global funds, obviously Blackstone, and typically, say, TPG has had Newbridge in Asia and been a sort of long-term player. KKR have set up significant infrastructure in Beijing and Hong Kong and Tokyo. And then we've got some of the Pan-Asian funds, CVC, a long-term participant, and then newer players like Olympus or CITIC or SAF. Some of them have got origins in China, now looking to do deals in Japan and Korea. And then interestingly, in China we have some homegrown funds, some of them out-of-government organisations, Legend and Honey, for example, actually been doing private equity type investing in China for 10 years or so. So, very interesting sort of layers of experience and layers of activity. And the other thing to note too, is perhaps touched on earlier, is that the teams that we're seeing in China are very well credentialed, and probably in contrast to thinking about Australia in the late 90s and private equity, substantially more experience. As with most of the markets, being local is pretty important. Local networks, local influence, local understanding of objectives and culture and whatever. So just sort of turning to India, a different story in some ways, and often misses out on the Pan-Asian strategy. When you talk with particularly the US fund managers who are looking at Asia or part of Asia, they often find India just too hard to contemplate, but doesn't always make it into Pan-Asian strategies, but in contrast has a very well-developed domestic equity market and some quite interesting emerging private equity. Substantial economic growth, as we touched on before, is part of the Indian story, but also, in contrast to China, English is the major language, system of law, and a democratic nature of government, and a very educated English-speaking population. But India, as a long-standing listed market and private ownership of companies, is very established, often family groups or partnerships. More service orientation, and as you know, that the Indian economy has been quite a closed economy and liberalised since 1990, and so much of Indian business was built around servicing Indian needs. And over that period since 1990, the economy is increasingly sort of open to sort of global opportunities and global inputs. So Indian GDP growth has been quite substantial, and we've seen that emphasised in things like 30 times increase in mobile phone usage since 2000. Education has been a big driver in India. Some 400,000 engineers produced every year. And so from a source of skilled labour at reasonable cost, we think India is going to become a more interesting force, not just in services, but in various other industries like auto components, pharmaceuticals and specialised manufacturing. One of the issues for India is in infrastructure, and roads and power have been constraints on growth, and the expenditure expected in those sectors is going to be substantial. Gradual and continued deregulation and liberalisation and in reducing the role of government in the economy is going to be a really important driver and an ongoing push for growth and opportunity in India. Listed markets in India are an interesting source of capital for companies and a pretty active competitor for private equity in some respect. We're going to see sort of the ability of Indian private equity firms to be very influential based on relationships and bringing real skill and value to the table. The other side of having a strong listed market is that it's a great opportunity for exits in India, and we see a lot of exits going on to the Indian Stock Exchange in Mumbai. Again, characteristics of private equity, large funds, the global funds, we see Blackstone in India and a few of the other players. US venture, Sequoia's got an office in India, very similar story to China in terms of looking at taking models from elsewhere. With the exception in India being telephony and the use of mobile phones, some very interesting homegrown technology and software and uses, as the mobile phone is really an integral part of communications in India and used for a range of things that we don't actually use it for here. Not to be underestimated in India is that Indian diaspora, which is particularly West Coast focused in the US and often in IT, and we're seeing many of those return to India with not only just skill but also ambition to do something exciting for India. And finally, Japan, the longest standing PE market, and some of it actually began very early, some 15 years ago. Again, very regulated market, minority positions were the mainstay. That's changed a bit over the last couple of years. We're actually seeing a much more buyout focus as we see some of the large firms gather. But Japan has some interesting characteristics really around relationships. Networks are extremely critical for deal flow. Deals take a long time, and a lot of the work on how a deal is going to operate and the change is all negotiated up front, as the whole issue of management and focus of management is very different to other economies, and there isn't really an active management class available to be put into new businesses. So there's a lot of time and effort and relationship building undertaken with existing management teams to ensure the success of the private equity transaction post-investment. So just capturing a few of the final issues. Traffic. Infrastructure in India and China are going to be an ongoing challenge, more so in India, but certainly in both. For both countries, there's still going to be a substantial rural population base, and participating in the good fortune of that growth is going to be an ongoing issue for policymakers. And culture, working through the history and the way of doing things and building businesses within that environment to make them take the best opportunities and work them. So implementation, obviously there's a couple of ways to look at it. You can go direct and try and do deals, but very difficult. Manage general partners in those areas. Team recruitment has been an ongoing issue. Experience is building, but turnover and instability has been a hallmark in Asia. We expect that to settle. For investors, investing direct is going to be difficult. What we're seeing is some advisors now concentrating on the area and some fund of funds. We've seen a rush of US capital in particular to China and to Japan and to a lesser degree into India. We're even seeing funds today being access constrained, which is a little concerning given the still emerging nature of the market. A cautionary note about thinking about private equity in Asia. The fund you can get into may be the one you don't want to be in. And from an Australian investor's perspective, a couple of points to note: the tax and structuring in Asian fund structures are largely driven around US pension funds, so not necessarily straightforward or friendly for Australian investors and superannuation investors. So complexity of some of those structures, China is often via the Caymans, India via Mauritius, and Japan via the Caymans or Ireland. And Australia's tax treaties with these countries are not necessarily very helpful in terms of allowing easy access to capital gains as the tax basis for these transactions. So in conclusion, a huge growth opportunity in China and India. Japan, a transition story, but one with tremendous potential, we believe, as well. Markets very much in contrast, the stage of the Australian market in the late 90s, early 2000s. Firms are developing, market infrastructure developing, emerging role of private equity in the economy, going to only become more and more part and embedded in the economy. Skills developing at management companies and investee companies as well as in private equity firms. Track records to date limited in a realised form, but we see over the next few years we will see over the next few years real evidence of the capacity and the ability to build private equity opportunities.
Fiona Trafford-Walker from Frontier. Just a question, Judith, on the way of doing business in some of these countries. I read a book called Mr. China, which I'm not sure is that what you're referring to on your presentation, but the thing that struck me was just the way of doing business was so different to here, and what pitfalls that might create for investors.
I think that's really why it's important to, when you're looking at firms in those markets, that being local is pretty important, to have firms that have got good local networks and understand the local dynamics and the local issues. And in China, certainly, it's having those links into government to understand where the sensitivities are, where regulation, etc., may be impacting on what the businesses you're looking to invest in, and how to work with government to get there. When you look at India, it's a different dynamic, but certainly, if you read about India, you'll see sort of terms like the Raj licence economy. And there seems to be sort of like two economies still in India, those of the old days and where businesses were licensed, and that was sort of licensed to print money, and the new era where people are looking to build robust businesses that stand alone and have strong heritage of ethical dealing, etc. So, but again, I think in all of those cases you can't overemphasise the need to be local. In Japan, local deal flow and local networks are very important, and being able to understand the culture around management is very important. And if you tread heavily on those things, you'll find it very difficult to go back and find deal flow again.
Judith, if a fund had 3 investments in front of them to decide on, and they were all very similar in terms of the aspects and the returns they were going to get, one was in China, one was in India, and one was in Japan, do you have a view about which way you'd go?
I'd probably, if I was thinking, put something there for the next 30 years, and it was sort of like a once decision, I'd probably go with India. I think despite what looks like some near-term issues, I think there's a strength and a robustness that will serve it well over the long term.